This chart depicting the federal funds rate is crucial for predicting the future of nearly every market from automobiles to stocks. The federal funds rate is the benchmark rate set by the US government, which influences various rates including business loans, certificates of deposit, treasury bonds, mortgages, and car loans. Understanding where this rate is headed and its changes will allow you to essentially predict where the markets are going. The basic idea here is that when interest rates rise, they act like a force pulling down on stock prices. The reasons are straightforward. First, the cost of borrowing increases. Companies often rely on loans to expand. They build new facilities, hire additional staff, and invest in research. If expansion slows down, profits usually do too. Additionally, higher interest rates impact consumers. With more expensive loans and credit, people tend to spend less. Furthermore, higher rates often attract other investment opportunities. For example, you can now get a 5% return on a certificate of deposit, which is guaranteed. For many, this is a safer option than risking their money in the volatile equity markets. All these factors combine to make this statistic incredibly significant. It's like gravity on the market. The stronger the pull, the harder it is for the economy to soar. You might be wondering, if higher interest rates can drag down the economy, why not just keep them low to ensure the economy and your finances flourish? The straightforward answer is inflation. The idea is that as you reduce this financial gravity, making economic activities easier, speculation starts to increase and bubbles can form. Over time, the market may overheat, which leads to significant price increases across the board. This is inflation, and it's something the government aims to control using this important tool. The federal target for inflation is around 2%, and they adjust interest rates as a lever to help achieve this goal. If you've been following along, you'll know that inflation soared after 2020. By 2022, it reached 9%, some of the highest levels since the 1980s. In response, the Federal Reserve took action by raising interest rates starting in January of 2022. They continued to raise them until August 2023. If you look at the inflation chart, it appears that their strategy worked. The consumer price index dropped from that 9% peak to about 3%, and by last year, there was talk of the Fed being ready to lower rates again, suggesting that their job was done. However, while managing this, they inadvertently impacted various markets. For instance, in 2022, the S&P 500 lost about 20% of its value, affecting 401ks across America. Mortgage rates also jumped from 3% to 8%, significantly increasing the monthly cost of owning a home. Since last year, there's been a loud call to cut interest rates. The prevailing sentiment was that the Federal Reserve had done its job, so it was time to lower the rates and boost the economy. With these expectations, the market began to rally. From August, when we stopped raising rates, to late March, the S&P 500 climbed by 26%, largely driven by the belief that the Federal Reserve would start cutting rates. However, recent developments have shifted this outlook. Initially, as the consumer price index started to fall, there was hope it would stabilize below the 2% target, but instead, the inflation rate has leveled off around 3%, altering the economic forecast and market expectations. From the recent surge, it seems that the Federal Reserve is concerned that inflation might be sticky or hard to reduce. You might think 3% is close to 2%, what's the big deal? However, the worry is that despite high interest rates, we're not making progress towards lowering it to 2%. This concern is rooted in history. Back in the 1980s, we faced a similar struggle with inflation, which is less known for its stubborn recurrence. For instance, in 1975, inflation rose to 12% and then started to drop. Yet it spiked again, reaching 15% in 1980 and remained relatively high until about 1998. This pattern shows that once inflation takes hold, it can be tough to control. In fact, it was Paul Volcker's drastic action in the 1980s, raising rates to 20%, that finally made a significant impact, though higher than usual inflation persisted for decades afterward. Given this historical context, many are concerned that the Federal Reserve might need to take similar drastic measures. The initial plan to cut rates could be abandoned, especially if the consumer price index continues to rise. This issue has grown so significant that numerous experts believe the Fed is considering a rate hike. If this belief takes hold, it could naturally lead to negative impacts across all markets. Despite significant increases in the federal funds rate since 2020, the overall stock market remains quite expensive. This is partly because speculators are convinced that the Fed will soon lower rates again. The Buffett indicator, widely regarded as a reliable measure of stock market value, indicates that in May 2024, the market is significantly overvalued, approaching near all-time highs seen in 2021. Currently, the stock market is nearly 2 standard deviations away from what would be considered a historically normal level, and all of this is occurring while interest rates are high. So what should the Fed do? Based on current stock valuations and inflation figures, the logical step would be to raise rates. It's increasingly clear that the current rates aren't sufficient. If inflation continues to rise and the stock market remains high, Chairman Powell may be compelled to raise rates significantly. The extent and duration of such adjustments remains speculative, but if history is any guide, actions similar to those taken by Paul Volcker in the 1980s could still be on the table. This is why people like John Hussman, a hedge fund manager, believe that serious pain is coming to the stock market, partially because of this reality. Take a listen to this interview clip where he explains exactly this.
I believe folks who listen can connect the dots and come to this conclusion, but just to make sure it's crystal clear, based on my intro, I just got to ask the question, sure, are we in a bubble? And if so, how big and how worried should we be? I did hear you use the word, unprecedented, at least in terms of levels of speculation, comparing it to 29 and 2000. I don't want to put words in your mouth. So if you can just straight from the horse's mouth say, are we in a bubble?
Yeah, I think it's unquestionable that we are in a speculative bubble, and in fact, the largest one that we've had in U.S. history. My latest market comment refrains some of Jeremy Grantham's views on this as well. And really what we're looking at here is a situation where valuations have gotten to the point where they're actually, and it's actually spectacular. The valuation measures that we find most strongly correlated with subsequent market returns, looking back not only over recent decades, but all the way back to the early 1900s, right? Those valuation measures are now 50% higher than the valuations that were never seen before late last year, right? So we're so far beyond what we've seen in other bubbles.
Now, you may hear that and start to think just how horrible the market is, but as always, we're going to end this video on a more positive note. Yes, it is true that evaluations are close to all-time highs and inflation is starting to look sticky, but even when we talk about an era like the one from 1990 to 1998, there is a lesson here. This was an era of multiple recessions, many of which were blamed on the Fed actions to control inflation. And it was also an era of persistent, horrific inflation. Yet, if you had put $1,000 into the S&P 500 in 1980 and just left it there, it would be worth $21,400 in 1998. This shows an annual return of 17.51% if you had reinvested your dividends. So despite all the bad there, it was still an opportunity in the US markets. Like Warren Buffett says, never bet against America, and despite all the troubles, we've found a way. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know in the comments below if you think we are currently in a stock market bubble.